Hello friends. Welcome back to Finance Central. In today's video we will learn how to do the fundamental analysis of a stock in simple language and with real examples. Because of this, you will have the much needed confidence in stock investing in order to create wealth. This I will guarantee. So let's begin. So the first question is, why do our own analysis? The simple answer to that is, we should use our own knowledge to pick stocks, form our own opinion, use our own logic to evaluate how good a company is. This is the only way to actually create wealth. Because in the stock market, it is possible to buy stocks without research, but we cannot become a true investor. We may even earn some short-term profits, but we won't be able to generate wealth and neither achieve financial freedom. So let us understand, what is fundamental analysis exactly? We analyze the basics of business in this. And by the end of the video, you will realize that all you need is common sense, which most people do not use. So, in the analysis, the first thing to look at is whether the business is making any profits or not. If the profits aren't growing, then it really doesn't matter if the stock price is going up. At some point the stock price will come down. Any business must generate profits to grow. The next thing we want to look at is whether the business can continue generating profits in the future. And if it can, then how fast? We also want to evaluate the possibility of the company closing. Because if the company shuts, it could erode all our money. Next, we find out how good the management is, and what are they planning for the future growth? We then look at the competitors and understand how the company handles the competition, etc., etc. And finally, we check the company's evaluation, whether it is low or expensive. Now you may wonder, where will we get all these information regarding the company? For this we will use a website called Ticker Tape. We will get almost all the information right there. I hope you are following along. We select the screener option on the top left. Click the stock universe, open the drop-down box and select Nifty 100, then select sector, open drop-down and select consumer staples. I will share the link to Ticker Tape on the card above and also in the description area. Click the add filter option on bottom left and select 5 years historical EPS growth. Now sort the chart from top to bottom. Now from this list, let us study Britannia as an example. At the moment we will ignore the share price completely and neither its price to earnings ratio. We will have this discussion later. We will first check the quality of the product and investment. Because as we previously understood, it is possible for a stock price to keep rising even though the fundamentals of the company is weak. This keeps happening in the stock market and you should be careful. Let me show you a real example. Let us check Adani Green. Now let us check the Financials tab. You can now see the income statement. Let us first understand, what exactly is an income statement? Basically this income statement, very commonly also known as the profit and loss statement, tells us the amount of profit a company makes within 1 year. And if it has an earned profit, then what is the loss incurred? This statement gives us a detailed breakdown. At the top we have revenue, the total revenue earned by a company after sales. We also refer this as top line, because we have to reduce the various expenses from this amount. Example, we can click the See Cost button. As you can see the cost for raw material, or employee salary and the various other expenses that are deducted from the total revenue. And by deducting expense from income, at the bottom, we get the net income. This is the actual profit the company has generated, which increases the value of the company in the long run. So let's evaluate this. As you can see in the 2016 the revenue of the company was 0, and therefore they incurred a net loss. You can see the negative sign here, because any company has certain fixed costs involved. Now as we check the 2020 revenue, we see that the revenue has grown, but their net income is still negative. This is because the company's PBIT, that is the profit before interest and tax which the company has earned. From this earning the company is yet to fulfill bank loans and government taxes. So as you can see the PBIT was 949 crores and after paying interest and loans, it became minus 49 crores. What we understand from this is that the company has a lot of debt to clear. As you can see, the debt to equity ratio is 6:1. Companies with such high debts are extremely risky. The chances of them going bankrupt is very high. As you can see in the checklist, the default probability is high. So then how is it possible for a company to incur continuous losses and have its stock price rise from 50 rupees to over 1,000? The answer to this is very simple. It's called sentiments. When we read the annual report of the company has mentioned its goals till 2030, and its plans on how to achieve it. There are still 9 years left and there is a good chance the stock can crash. When this will happen? No one knows. But why this will happen? That, I will explain in a simple and logical way. The price of the company has already skyrocketed, and the earnings aren't very credible. Even if the earnings grow, we know it won't happen overnight. The company itself mentions that the target plan is for 2030, and that they have a lot in store. But tell me, how many investors do you think will hold on to the stock for 10 years? Imagine the people who have recently invested, right at the top, at the highest price. Those people have plainly invested looking at the stock price jump, and perhaps seeing the word green next to its name. Any true investor who intends to hold a stock for 10 years, won't bet his money on this stock. Warren Buffett uses a very simple statement for such companies. I don't look to jump over 7-foot bars, I look around for 1-foot bars that I can step over. An example of this is, imagine on Mars, by 2030, if someone tells you that Elon Musk will take you to the planet, where he plans to construct buildings, and that you can purchase land as investment. We would call this, jumping over a 7-foot bar. The risk is too big than the reward, for an uncertain future. We don't know if this can actually happen. And the biggest risk here is that you do not know. On the other hand, if you have apartments on sale in your neighborhood, and if you could purchase an apartment from those options and invest, then what is the need to go to Mars? To invest in the land next to you, is called climbing over a 1-foot bar. Once in 10 years, there is always a stock market correction or recession. At such times you get good companies at cheaper valuations. That is why most of these new investors won't hold on to this stock for long term. These investors don't have enough trust in the company. One bad news, and all the investors will line up to sell their stocks. This is what we call a stock bubble, which needs only one bad news to burst. Around 80 years back, Benjamin Graham has said some important words. You are neither right nor wrong because the crowd agrees or disagrees with you. You are right because your data and reasoning is right. Because if you chase the crowd, you will get the same treatment that the crowd gets. Sadly, this is why the stock market has a bad name. Because most people invest by looking at the name and the past returns. But if you open the annual report of the company, you will be leagues ahead of the crowd. That is why we must only pick those companies that we have researched ourselves. Don't be blinded like the crowd. Now let me share another interesting thing. In the world of academic finance, this stock is considered low risk. But we know that the stock is very risky. That is why it seems a little stupid to agree with the concept of risk in academic finance. Warren Buffett calls the portfolio of academic finance theory a joke. Now let us come back to Britannia. We have a long-standing track record in front of us. Let us now analyze this. Before we click the financials, let us first understand the history of Britannia, which we can do so by visiting the company website. As you can see, this company started in 1892. And in 1918, which is almost 100 years back, this company became a public limited company. Which means, the IPO of this company came 100 years back. In 2012, the revenue of this company was 5.5 thousand crores. This means, that year they generated business worth that amount, which over the next 8 years has grown to 11.8 thousand crores. As you can see, they have doubled their revenue in the last 8 years. Now let us calculate the rate at which the company has grown. Let me take these figures in Excel, and add a formula to get the annual revenue growth. As you can see, the company has grown its revenue, that is sales, at the rate of 10%. And as you can see, the profit has grown at the rate of 27%. This tells us that apart from growing its revenue, the company is constantly reducing its expenses. Therefore, the bottom line, that is the net profit, is constantly growing. To grow profits, the company can do two things. Either increase the revenue by increasing the sales, or increase profit margins by reducing expenses and cutting cost. This company seems to be doing both, and you will notice every good company does the same. As you can see in the checklist, it mentions that the revenue of this company is growing faster than the revenue of the industry. And because of good and efficient management, we can see that they have mentioned here, about the net income growing faster than the industry revenue, as discussed earlier. The third indicator showcases the increased market share. This is also an important parameter. Market share means, imagine in India, as an example, if in 1 year there are biscuits worth 100 rupees sold. Worth how much rupees did Britannia sell its biscuits? If out of 100 rupees, Britannia makes a sale of 22 rupees, and its competitor Parle makes a sale of 26 rupees. Then the market share of Britannia is 22%. So a growing market share would mean, that the consumers would leave the competitors' biscuits, and buy their biscuits. And this is why, as you can, the revenue of the company is growing faster than the revenue of the industry. Let me read out what they have written. A higher than industry revenue growth represents increased potential for the company to increase their market share. This is what we previously understood with a very simple example. Also, there is a very simple explanation for why the market share of the company has grown. Let me explain. Parle G biscuits have become a bit old school. Consumers are increasing their standard of living. Everyone now owns a smartphone. People order food from good restaurants. They travel by flight. There is a growing demand for premium products. Therefore, Good Day Biscuits, which is their flagship product, is growing exponentially. In comparison to the Parle G biscuits, Good Day is positioned as a premium biscuit. Good Day is now a better choice to offer guests when they come over. If we open their annual report by clicking here, and if we look at the market share, the management has explicitly mentioned over 5 times that growing the market share was a deliberate effort. This didn't happen on its own. As you see here, despite the challenging business environment during the year 2019 to 2020, your company was able to increase its market share and improve profitability through innovations, cost efficiency programs, and expansion in distribution. These were the exact same things which we analyzed previously. And if we look at dividends, the company has continuously paid good dividends to its shareholders. As you can see, it's mentioned here, Britannia has increased dividends consistently over the last 5 years. Which means not only have they paid the dividends regularly, but also increased them every year. And if you notice, the company paid 2 dividends last year, in April and in August. This was the very time when the stock market was crashing and all companies were falling, due to the pandemic. This is why investing in good companies is as good as having a money printing machine. The fluctuations in stock prices become irrelevant. It won't matter whether there is a bull run or a bear market. Because good companies always earn good revenue consistently, in any market conditions, because of which their profits are continuously increasing. They also end up paying their dividends in time, without fail. So tell me in the comments below, between Adani Green and Britannia, which company has a possibility of a permanent capital loss? And which company can actually generate wealth? Those of you who are following my channel will find this simple. Given that you have seen the previous video and are also at the end of this video, please do like and share this video with your friends and family, and help them understand and become wiser in the stock market. Now, even though the company is good, many of you may find the company price too expensive for your pockets. We will discuss this in our future videos. For that, don't forget to subscribe to the channel. And press the bell icon, so that you don't miss out on other important videos like these. So guys, this was a very simple understanding on how to do a basic fundamental analysis of any stock. And I am sure you now know that it isn't as complicated as it looks. With such smart analysis you can save yourself from losses. I suggest you subscribe to the pro version of Ticker Tape. There are many additional features which can help in further analyzing a stock, and is extremely time saving. I will leave the link in the description. And if you want to open a free DMAT account, I will put that link in the description as well. That's all for today guys. Do let us know if you liked the analysis and if you learned anything from this video. We would love to hear from you. Thank you for your valuable time. See you in the next video.